Ladies and gents, clients and future clients, thank you for taking the time to allow us to properly introduce the Prescient Balanced Fund to you all. Welcome. We hope that our webinar tweaks your interest and that you gain some profound insights into our systematic, big data-driven investment approach. I'm Kirsty Jeffries, and today we're going to be discussing the Prescient Balanced Fund, our fund's philosophy, what differentiates it from the peers, and then we'll focus on the investment process, backing it up with fund performance. I'll take us through the business update and fund philosophy before passing you on to our multi-asset team, or at least two of the members, Bastian and Rupert. Let me set the scene with a business update. Prescient was founded in 1998 by Herman Stain and Guy Toms. We are a very proud 22 years old with a long track record of managing money to give clients peace of mind. Prescient Investment Management, for those of you that don't know, is 100% a subsidiary of Prescient Holdings. We have sister companies in the forms of Prescient Fund Services, Prescient Management Company, Prescient Securities, we've got Prescient China, Prescient Ireland. So the numerous businesses and Prescient Investment Management in itself, during COVID, we actually hit a milestone of 102 billion assets under management. Within our business, the staff and founders hold 38% equity, and we're a level 1 BE rated business. Looking at our AUM from that perspective, we're very pleased to see that our multi-asset split and percentage of the assets under administration under management has grown to 14%, with the multi-asset team actually managing a further 20 billion in tactical asset allocation strategies. Okay, moving on. I'd like to take a few minutes to remind us of what makes a strong and good team. At Prescient, we actually employ Rassie Erasmus's stance in that the bomb squad, being the bench, needs to be as strong as your starting lineup. So within each of our teams, within the investment team, you could say the interest-bearing team, multi-asset team, and equities team, you'll find that we have a very strong bench. We have a graduate program, and we're always training what we would call our analysts to be able to step into the shoes of the portfolio manager, should they ever need to do so. Beyond that, like with any good rugby team, you're always going to need a very strong management team. So our Prescient business team is obviously led by Cherie Dyers, our CEO. We have marketing, operations, investment support that all supports that investment team. And beyond that, looking more to what we're talking to today, we've got the Prescient retail team. I mention that because some of you will not have had a face-to-face introduction with us, so I thought I'd run through it quickly with Maya Kutsia being the head of retail based in Cape Town. We've got Emma Potts based in KwaZulu-Natal, Davy Carstens in Cape Town, myself in Gauteng Central, Jason Hinton in Gauteng North, Limpopo, Mpumalanga and Northwest, Gabriel Buerta, he does business development in the Eastern Cape as well as Free State. And supporting us is both Tuki and Danielle. Please feel free to reach out to your respective business consultant, and I'm sure they'll happily set up time to take you through any further detail, should that be of interest to you. Right, so let's get into the fund philosophy. I'd like you to afford me a couple minutes just to remind us of the investment case for the Prescient Balanced Fund. I'm sure that we all agree that within a client investment analysis and planning process, asset allocation is the key driver of potential success. It's absolutely critical to get the decision right on whether the client, for example, goes offshore, stays local, invests in alternative or traditional assets, invests in income, balanced or equity funds, etc. Once that decision has been agreed upon and a balanced fund is decided to be the right choice, the right balanced fund needs to be identified from literally hundreds of choices and thousands of blended permutations. An astute investor should be able to construct portfolios for his clients that can deliver above average returns consistently, but we all know that in reality, it's not very easy. The Prescient Balanced Fund was designed to deliver on exactly that. It aims to outperform the other balanced funds in the South African market with some form of predictability. So the fund should never be bottom and it should never shoot out the lights over the shorter term. So There's a Chinese proverb that states, those who shoot the lights out end up in darkness. So it's not really Chinese wisdom, but I thought it illustrates the link between risk and return quite effectively. So if we go to our mantra of systematic evidence-based investing and review the last 6+ years of the Prescient Balanced Fund history, we can see that if you look at that rolling return versus all the funds in the CISA multi-asset high equity category, you can see that the blue line here depicting our Prescient Balanced Fund almost always is above average. And more noticeably, it's never bottom quartile. And this is exactly what we're aiming to achieve. If you go to our 3-year period, you will notice that the wonder of compounding above average returns comes through strongly in a consistent profile that ends up top quartile. In fact, if we look at the dispersion returns over various periods, you'll actually notice that over 1 year periods, the fund has above average returns for over 90% of the time, and only 10% of the time is it below average. This results in a profile that is top quartile 100% over the time, over 3 years and rolling 5-year periods. At Prescient, we are confident that this is the trend that will prevail in years to come. So you might ask, what is the process behind this? Well, it's actually very simple. Can move on. We don't debate whether a 4x4 or a sports car is the best vehicle. We'd actually prefer a fast all-wheel drive sports utility car. Likewise, we don't really debate whether active or passive management is better. We like to take bets on both. We like to take the best of both and combine their best attributes into one product. So what does this actually mean? From a passive product perspective, the key attributes are low fees, low transaction costs, and low tracking error. From an active product, the attributes are potential of alpha, which we deliver actually through portable alpha process, efficient allocation of capital, which we deliver through detailed strategic asset allocation process, and then capturing market dislocations, which we deliver through a robust tactical asset allocation process. When you combine these attributes, what you get is a very efficient allocation of capital within the Prescient Balanced Fund. So before letting you go through to speak to Rupert and Bastian, I thought I'd do a quick introduction. So Bastian is the head of asset allocation and research at Prescient Investment Management, with Rupert being one of the portfolio managers within his team. They are going to take you through our investment process and specifically point to the sources of alpha that you will have noticed within the previous diagram. So we've got low fees. We have got a strategic asset allocation that delivers alpha, a tactical asset allocation which delivers alpha, and we use portable alpha, which they'll explain to you. I hope that you enjoy it. Please feel free to post any questions. We'll be keeping an eye on that, and we'll most certainly get back to you. Thank you very much. Over to you, Bastian and Rupert.
Thank you, Kirsty. Thanks for the very good intro, and thanks from our side to everybody for giving us the time and the opportunity to present not just our process, but also our current market views and how we see the investment world. So I'm going to start by quickly outlining our process from a top-down point of view. So a top-down point of view is a good intro, actually, because it describes how we see the world. So we are not bottom-up at all. We are really seeing the world from a top-down perspective, and we are just very convinced that this is a more promising approach. Having said that, we have 5 steps in our investment process. We start at the top right with our strategic asset allocation. So that's our starting point. And what we're doing here is we are making forward-looking capital market assumptions, which we combine with historical correlations and historical volatility, and we derive within a mean variance framework sharp optimal portfolios which tell us exactly how to asset allocate over the long term. Okay, after we've defined the long term, we're going to move into tactical asset allocation, which is step 2 in our process. What we're doing here is that we are tilting away from the long-term optimum by applying PAA tilts. So as an example, if we deem a certain asset class as more attractive than the other, we might overweight that asset class, and in return we will underweight another asset class. It's important to highlight, though, that this comes on top of our strategic asset allocation, so it can really be seen as step 2. We do think that it's crucial to spend a lot of time on the strategic asset allocation in the beginning. Step 3 would then be portfolio construction. So let's say we've established we want 40% equity strategically. Maybe we are currently more optimistic on equities, so we might have a tactical asset allocation tilt taking us from 40 to 45. Okay, so once we are at 45, how do we get 45% equity exposure? And that's where portfolio construction comes into play. This is where we are applying our in-house portable alpha approach. So what we're doing is we're basically creating fixed income alpha and reporting it on top of our equity building block. So we are no believers in stock picking. So we don't think that it's easy and sustainable to generate alpha on the equity side. So we completely go away from this approach. We use equity futures and we port our fixed income alpha on top. So you get basically the alpha profile of our income strategies, but you get the beta profile of the equity market. So you get a very consistent outperformance of the equity market. Step 4 would then be implementation and trading. We're going to skip that in today's presentation simply because we don't have enough time, but it's a very important step in our process as well. So we are very efficient when it comes to implementation and trading, and we are almost obsessed with reducing trading costs and transaction costs and giving you the cheapest way to get market exposure. Okay, step 5, and that's no coincidence, that step 5, risk management, sits at the heart of our process. This is what we think we are particularly good in. So when we speak about the Prescient Balanced Fund, it's about peer risk. So we are tracking peer risk very, very closely. We are not trying to capture troughs or peaks, but we are trying to always outperform our peers by a little bit. So if you're looking for a fund which is more peer cognizant and gives you stability and beats the peer groups through time, then we think there's no better choice than the Prescient Balanced Fund. Okay, so let's move into those individual building blocks. We're going to go into 3 of them. So step 1, strategic asset allocation. I'm going to showcase what we're doing there and how it leads to alpha. Then I'm going to hand over to Rupert. He's going to cover step 2, which is tactical asset allocation. He's going to showcase how we systematically do asset class tilts, which help us to outperform the strategic allocation even. And then I'm going to cover step 3 again, which is portable alpha, where we showcase how easy it actually is to create equity alpha if you just take fixed income alpha and put it on top of equity beta. Okay, so what are we doing in our strategic asset allocation? It starts with long-term return expectations. So we have to formulate a view on what returns we will achieve in the set of asset classes over the long term. We can't just look at historic averages simply because the world changes and markets change and the investment environment changes. There's structural shifts which we have to reflect in our portfolios. And this is the first reason why we are not believers in pure passive balanced funds, because we are convinced that these long-term return expectations do change. And if the long-term return expectation changes, you have to change your portfolio. Good example would be the real return on cash. So that's what you can see on this chart. So what we're showing here is the Thomas Laubach and John Williams estimate of the natural real rate. So it's basically an estimate of the Federal Reserve in the United States, estimating what cash will give you in real terms. That's the red line. Okay, the gray line is what the real return in cash actually has been. So if you basically put your money in the US dollar denominated bank account and you deduct US inflation, the gray line is your return profile. The blue line is our long-term expected real return over the foreseeable future. So what you can see is that the blue line only sits at 0.3. So we expect cash to only give you a 0.3% real return going forward. And why am I highlighting cash and the real return of cash? There's 2 reasons. First of all, it's a building block for all our real return assumptions on all the asset classes. So we have to understand cash to understand other asset classes. And secondly, it's also an interesting one because we have made an assumption, change to our assumption. We've reduced the real return of cash from 0.7 to 0.3. And that's just one example how we are active on the strategic asset allocation side, where we built in structural shifts. So now after COVID and looking at the world, not over the short term, not at the recovery after COVID, looking at structural breaks, which you've seen through this crisis, but also through the crisis before, what we expect for the long term going forward is lower interest rates for lower, but not necessarily much lower inflation. So we expect inflation to revert back to the long-term average, call it 2% in the United States, and we think actually 6%, including an inflation risk premium in South Africa. But if we look at interest rates, we do think that despite inflation moving back to the long-term average, we do think that interest rates are going to be lower. So that means that investing becomes tougher, income-linked asset classes or cash-linked asset classes become less attractive, and it's just tougher to beat inflation. It's doable, and we think our fund is well equipped to do so, but the environment is getting tougher. Okay, so now we're looking at another example where we made an adjustment on our long-term real return assumptions. This is an example for developed market equity returns. So the gray line would be the S&P earnings yield through time, and the red line would be the long-term average, which is just above 6%. And we've now adjusted our long-term return expectations down to 5.5%. So we expect global equities to do 5.5% real going forward. Why have we adjusted the number lower? Again, due to structural breaks, due to the fact that interest rates are going to be lower for the foreseeable future, due to the fact that we have shifted more towards the tech sector, which means that we can justify slightly higher PE ratios, and in return, that means we can justify a lower earnings yield, which is in the short term, meaning that we're not as bearish as one would be if one look at the whole history, but over the long term, it means that going forward, we expect lower real returns from equities. Okay, so we form all of these real return assumptions. It's a quite comprehensive process behind it because we are so convinced that it's absolutely crucial to get that right. We form these real return expectations and we feed them into the chart on the left-hand side on the y-axis. So those expected returns of the individual asset classes are exactly what I've just presented to you. And then on the x-axis, we take historical volatility. Okay, so historical volatility, as we think, is the best measure for future volatility. It's very, very difficult to predict structural breaks in volatility, so we don't do that. Okay, so you see the volatility on the x-axis, the expected return on the y-axis. What you don't see is correlation, but obviously it's taken into account. It's just not charted on this chart. And then all the light blue dots would be the sharp optimal portfolio combination. So basically, those are all the combinations of portfolios where you get the maximum return per a given unit of risk, or putting it other way around, you're getting the minimum risk for a given expected minimum return. We choose CPI plus 6 as our return target, which is where that small dark blue cross sits amongst these blue dots. And if we zoom into this portfolio, then on the right-hand side, you can see our strategic asset allocation. So that would not be significantly different to what most our peers do in the CISA high equity category, but that's good news because we don't want to be all that different. We want to be different in our investment approach, but remember that we're trying to beat them by small margins through time. That means we are only willing to take a small tracking error. So our starting point can't be too different. As you see, roughly 40% equities, 5% properties. We've got 9% bonds, 3% ILBs, 5% alternatives. We've got South African high yield corporates, which is 5%, 3% preference shares. Look into the offshore space. We've got 18% developed market equities, 7% EM equities. So we do this clean split between developed market and emerging market equities. And we have 5% developed market bonds. You can see the outer ring, that's our currency exposure. So what we're saying here is, yes, you should have 30% offshore, simply because offshore, the opportunity set is bigger. But being offshore doesn't mean that you have to have 30% US dollar exposure. We do think that for a rand-denominated fund, it does make sense to have a small portion of the currency exposure hedged back into rands. This is not our gut feeling. This is not our understanding. It's what the optimizer gave us. So giving all our assumptions, given the volatility, given the correlations, the optimal portfolio hedges a small portion of the foreign currency exposure. Okay, so that's basically our strategic asset allocation. So it's no rocket science. It's a simple mean variance optimization as one would see it in the textbook, but I think the trick really lies in the execution. So we have forward-looking real return assumptions. We are clean in the way that we run the optimizer. We take into account investment constraints like Reg 28 or SISCA, and yeah, we make sure that we can get this exposure without any layering of fees and without any significant trading costs. Okay, so that's part one, the strategic asset allocation. I'm going to now hand over to Rupert, who's going to cover the tactical asset allocation tilts.
Thanks, Bastian, and thanks everyone again for your time today. So what do we mean by tactical asset allocation? Bastian's mentioned that we have our firm foundations, which are built with the strategic asset allocations, for example, 40% into South African equities, and that when South African equities are seen as attractive, we do take small measured tilts into that asset class. So how do we achieve that? We have this list of asset classes available on the menu that matches the original asset classes that Bastian showed you in the return assumptions. And how this works is that we have a neutral standpoint when we don't have any view on the asset class that is in relation to our long-term return assumptions. So if we are to say that South African equities are currently neutral, that means that we are not overweight, not underweight, but we are right on the money on that long-term assumption. When we go underweight, it means that several of the factors are pointing towards negative contributions towards the outlook on that particular asset class. And then conversely, on the upside, we can go overweight into these asset classes when they look attractive. So as Bastian also mentioned, we are a systematic asset manager, which means that we use a lot of data on a daily basis, but we're very clear in saying that we're not a black box type manager. We use the data on a daily basis, that distilled data. Essentially, we take several million data points, we distill it down into what we think would make sense as a discretionary manager would, as they would manage their fund. But the difference is that we can observe all of those data points at one time, whereas for a discretionary manager, it's quite difficult to keep an eye on all of those different indicators at any one point in time. So we see ourselves as being free of human biases in that we can control for those biases. We don't pick particular indicators in particular regimes. We think that every indicator will contribute at some point in time. We do test those indicators to see that they are effective or have been effective historically. And once we're happy that they are a solid indicator of value, for instance, within an asset class, then we'll include it within our models. At the same time, we've got strict risk controls, which manage our allocations given certain mandates per fund. For instance, within the balanced fund, we're very peer cognizant, so we don't take tilts which are too far away from our strategic asset allocation and in turn too far away from our peer group. So digging a bit deeper into some of those asset classes, this is just a snapshot of what we essentially see on a daily basis and how the portfolios are run. So on the left, you'll see the signaling is basically red for a negative outlook and blue for a positive outlook. And when it's gray, it's roughly a neutral. So again, that means that we are indifferent as to whether we take tilts either way on that particular asset class. So at the moment in the US equities space, we are neutral on that asset class. We see the value case, which is one of our core 4-factor groupings, as being quite a strong negative. That's been quite negative for a while. So we've seen in the news for quite some time that US equities have been quite stretched on their valuations, especially given the rally in the big tech stocks. It's almost a reiteration of what we've seen in the late 90s, early 2000s, where investors are now taking a lot less in terms of yields for the prices that they're willing to pay. The economic picture is again quite negative. We use an aggregation of various different economic indicators like the yield curve, the US labor market. So in this case, it's US unemployment, which has shot up quite aggressively in the COVID-19 sell-off. And then financial conditions, which include various different spreads, funding pressure, monetary policy. That's the Fed that Bastian talked about earlier, the Federal Reserve, what they're doing in terms of monetary stimulus. And then lastly, we use a grouping called sentiment, which is dissected with business sentiment, consumer sentiment, and investor sentiment. And that just reflects the fact that we are cognizant that despite something like value being negative, at the same time, it might be that the end investor is still willing to take on that risk. So digging a bit deeper into what we mean by these variables, these metrics again are updated in real time. You'll see that this is up to date as of last night's close. You see this is a credit spread, so it's a proxy for risk. In the middle of the chart, you see how the credit spread blows out during the global financial crisis, which means that there is a higher level of risk in taking credit over base government bonds because of an implied higher risk of default of those companies. And you can see that in the early part of this year, that blows out once again. So that's during the COVID-19 sell-off. Not quite as much as it blew out during 2008, but it did blow out, which means that our signaling turns to negative, and it affects the overall outlook for our US equities. At the same time, we'll look in the sentiment. In this case, it's essentially the buying power of US consumers. So how positive the US consumer, the general consumer, feels on the street. You can see that during the Trump era, that has been ramping up quite considerably from quite a low base, Trump and Obama, I guess. But on the far right, you can see how aggressively that fell off during the lockdowns of COVID-19. And I think we've all felt that. We were all quite dismayed, if you like, as to what was going to be the future during March, April, when we were all sitting at home. Since then, that has rebounded in the United States. They've come back online quite a bit faster than we have, but that has seen a bit of a leveling off since then. So we're interested to see where that goes through the US elections. Another indicator that we look at here is monetary supply. So we're conscious of the fact that the US Fed has been feeding essentially free money into the system to try to stimulate the system. You can see that via the blue shaded area, the M2 money supply, which shows injections of money by the US Fed. What's interesting for us, though, is the velocity of money, which has dropped quite considerably. Essentially, what that means is that you are pumping money into the economy, but it's being spent at a much slower rate. So you're handing out money to, for instance, Joe the butcher. Joe the butcher, instead of spending it on his groceries, and then the grocery people spend it at the doctor, etc., Joe the butcher simply invests it within the stock market. So it's not nearly as effective as the Fed would have liked it to have been on the real economy. Now, looking across the sea at European equities, that's been a bit of a weak, negative case for quite some time. It's taken a further knock through the COVID-19 crisis. We've seen COVID-19 infections flare up once again across continental Europe. The value case there is extremely negative and has been so for quite some time. The sentiment case is also negative, so there isn't a very positive outlook within the European continent. Part of that is the Brexit agenda, which is still not decided. So that sort of thing is an example of what we look at on a daily basis. You can see on the bottom right, that red area, that red left-hand area shows that when our models in general are pointing towards the strong negative, the returns on the asset class are significantly lower than if they were pointing towards a strong positive, for example. So that's in essence how our models work. An example of that value case for European equities, this is the PE ratio on the Euro Stoxx 50. It's been chugging along around 20 or the high teens for quite some time. As soon as we get into the COVID-19 crisis, however, the earnings simply collapsed within European equities at the same time as the prices remaining relatively stable, implying that there is a lot less value within European equities and quite some room to fall on the price basis. That is assuming that the earnings do not recover. We also, as Bastian mentioned, we are very cognizant of the rand-dollar exchange rate, given that we have 30% of our portfolio allocated offshore. So what we do here is we monitor various macroeconomic indicators, which show whether there is value within the rand, for example, and whether there is a propensity for offshore investors to put their money into the rand, because that's also equally important. You have to have interested buyers for the price to go up again. So what we're seeing here is a strong value case for the rand, and that's existed for quite some time. But what we're seeing is a very neutral kind of standpoint for economics, financial conditions, and sentiment. An example of that value case for the rand, simply put, if you are a US investor and you borrow money in the United States, you change that to rands, and you invest within a risk-free 10-year government bond, or so almost risk-free government bond. You extract a premium which is now around or just north of 5%. That is, then you take it back after 1 year and put it into dollars. So for almost no risk for a US investor, you can get a 5% real return. So just in light of Bastian's earlier point on the real return on US cash, which is essentially negative and hovering around zero, for a US investor, it's extremely attractive to invest within South African rands at the moment. And we've seen that over the last month or two, the rand has been rallying back towards the 16 level. Why has that not been a more aggressive rally? Well, it takes quite a lot of an improvement in investor sentiment for the flows to come. So in this case, this is more on the bond front. This is bond sales to foreigners. So talking towards that case of the carry trade, the 5% premium you earn for investing in South Africa. Despite that attractive premium, the sales to foreigners remain suppressed and actually have remained negative. So we've been through a downgrade on the ratings. We've been through quite a few political turmoils in the past couple of years. So there is a level of risk that's associated with South Africa. If that was to change and the flows were to come back, we would expect the rand to appreciate further. So with that, I hand back to Bastian, who covers the next level of portable fixed income alpha. So just as a reminder, we've now covered the strategic long-term asset allocation, the foundation of the portfolio. We've covered the tactical asset allocation, which is the tilts away from that foundation of the portfolio. And now Bastian's going to cover an additional mechanism that we use to add consistent and stable portable fixed income alpha on top of that process.
Thanks, Rupert. Yeah, exactly. So that layers it out quite nicely. So it's basically step one, where we have a strategic asset allocation, where we make sure that we have an efficient allocation of capital, taking into account structural breaks, structural shifts, changes, for example, in long-term real returns in cash or inflation or equity risk premia. Step two, as Rupert says, we do the tilts. Everything purely systematically. But now step three is really within asset class alpha. And I mentioned already that we are no big fans of stock picking. So how do we create equity alpha if we don't stock pick? And the answer to that lies in our portable alpha process. So it's important to understand that we are aware that our balanced fund runs with roughly 65% equity exposure through time. So we can't have 65% of the fund not trying to generate alpha. So that's not good enough. So we want to be active, and we want to be active in the way that we create alpha in the equity building up. Okay, but now stock picking doesn't work. It has been proven that less than 20% of active stock pickers are successful through time. If you factor in their fees, if you look long enough, there's almost no way for them to outperform. So how can we do it? We think we can do it by looking at the fixed income space. If you look at the fixed income space, it's quite easy to beat the bank account. So creating fixed income alpha is quite doable. So the only puzzle which we have to solve now is how do we get fixed income alpha and ported on top of our equity or our property or our offshore building blocks. And that's exactly what you can see on the slide. So a little bit of basic math. If we think back to the no arbitrage pricing theory, which we've learned about it the first semester probably at university, you will recall that if you put your money in the bank account cash and you buy an equity futures, you get the market return. There's no way around this. So it can't be less, it can't be more, because it would be arbitraged. As simple as that. There's no gearing involved, there's no leverage involved, there is no counterparty risk involved because the futures are sitting with the exchange. So straightforward, there is almost no risk. And so now we say, what if we do not put our money in the bank account? And that brings us to the second part of the equation. So what if we still buy these futures to get the market exposure, but now we don't put our money in the bank account, but we use our money for buying rather income assets with a duration of a year or less, assets which are all investment grade, but assets which still beat the bank account, like pretty much in line with the process of our income provider fund, or basically a replication of that, but then on top of that, equity futures. So what you're getting then, and that's the bottom right green box, is you're getting the equity beta straight from the future. There is no leverage, no counterparty risk, nothing, but you get the alpha basically from an income fund against its benchmark, and that is far more reliable and far more stable, and it's also far more promising because it has a much higher hit ratio than stock picking. So how does the alpha profile of such approach look? And what we're showing here is basically through time the alpha which we've generated on our equity building block. So you can see the different lines in different colors. Those are the 252 trading days throughout the individual years. We're doing this process now for just above 6 years, so you would see the 6 individual years. And what you can see is that every single year we've managed to beat that bank account, and we've managed to create fixed income alpha, and we've managed to port it on top of our equity building block. So we can say that for our equity portion, 6 out of 6 years we had a positive alpha. There's not a lot of stock picking approaches which have gotten it that right. So there's something which a stock picker likes. He likes to select the right shares, speak a lot about his success, and then shoot out the lights. And then on the y-axis he would have an alpha profile of quite a few percentage points. Okay, as Kirsty said in her intro already, shooting out the lights is not always a good thing, because there's also a downside from doing that. And with any stock picking approach, yes, few of them are successful, but the problem is that most of them also go through a volatile journey. We don't do that. In our most successful equity alpha year, which was basically 2015, but I mean this year we are on track, we might still get there. In 2015, we had just 55-60 basis points of equity alpha. So if you tell a stock picker that in the best year, the maximum alpha you'll get is 60 basis points, you will not be very excited. But the flip side of the coin is that if you tell a stock picker that the worst equity alpha we've ever achieved was still 20 bips and it has never been negative, I think then he will be impressed. So it's straight in line with our philosophy, slow and steady wins the race. A little bit of alpha every year, it compounds through time, and it takes us right to the top. Okay, so just to recap, we've got 3 sources of alpha. We've got the strategic asset allocation, which is dynamic, which is active, where we adjust for structural breaks, and where we are, because of that, as I think, ahead of a pure passive balanced fund. Secondly, we are a full active fund, so we do believe in our ability to create TAA alpha based on capturing market dislocation. That was Rupert's section, TAA alpha, so we do that, and we've created that last year and the years before. And then thirdly, we do believe in actively creating alpha within the asset class, but again, we rely on portable alpha. It's more stable and it just works better. So we've got these 3 sources of alpha. We've got 3 reasons why we are ahead of the pure passive, and you will see it in the numbers. But if you still don't believe in any of anything which we just presented on, we think you should still buy our funds simply because the offering comes at such low fees. A client of mine, of us obviously, recently said, yes, he believes in the fact that you have to have low returns, and yes, he believes, sorry, low costs, and yes, he believes in the fact that you need a passive building block and you need to bring down your fees. But he said you must, but he doesn't want to do it because he doesn't want to sacrifice returns for management fees or quality of process. And I said, I'm on the same page. I mean, you shouldn't buy into a poor investment process just to bring your fees down. That's obviously not the point. But what we think is that we've got both offerings in one solution. So we basically give you a comprehensive active asset allocation approach we create within asset class alpha, but we are still coming at just 30 basis points management fee. And what we've done on this chart here actually debunks that whole theory that you are sacrificing the quality of process or returns by moving into a cheaper fund. What you can see on this chart is actually there's a clear correlation between low fees and market returns. So it's actually the other way around. If you want outstanding returns through time, you have to get your fees down. And you can see that obviously our balanced fund also stands out well on the scale. So we are very high in terms of annual returns, and we are very low in terms of management fees. Our management fee actually is just 30 bips. Okay, so it's all about slowly and steadily wins the race. It's not about shooting the lights out. It's about beating the peer group consistently, basically almost all the time. And Kirsty has shown this slide before. So 90% of the time we are ahead of the peer group, which is, and I still want to highlight it again, which is quite an achievement if you look at 1 year rolling returns, because the fund has almost like a 7-year history, and there's quite a few data points now if you measure them monthly. So even if we do that, more than 90% of the time we are in the first or second quartile. And as Kirsty said, there has not been a single observation where we've dropped into the last quartile. And then not only does your journey become very pleasant, not only will you never have to explain to your client why you have a last quartile fund, on top of that comes the fact that you actually, by just getting this consistency right, you are actually buying into a top performer. So the fund is mostly in the first decile even, and as said, over 3 years rolling, it has never dropped out of the first quartile, and over 5 years, obviously the picture is even clearer. Okay, so how do we get there? Just in a nutshell, and I think this is for me the best slide to really sum up the process and bring it all together in the end. It's literally it is about active and passive, but it's not substituting the one for the other. It's really like not sacrificing one part to get the other part. We always have this feeling that a lot of our clients feel pressured by costs and feel pressured by the trend towards more passive, and they say, yes, I will have to have a certain passive allocation, but I don't actually like it because I have to sacrifice an active portion, which I actually like. And like what we've done in the Prescient Balanced Fund is we are trying to really solve this puzzle. We think, yes, you can have all the nice attributes from a passive fund, which is low fees, as said, 30 basis points. You can have all the nice elements of a pure passive, namely low transaction costs. All our transaction costs are actually mostly lower than from the pure passives, because our portable alpha process is very, very efficient. And we've got low tracking error. So remember our strategic asset allocation. I think it's smart. I think I'm biased. I think it's smart. I think it's optimized. I think it's smart to have the diversification of all the small bucket of alternatives and currency hedging in there, but still we have a very low tracking error against peers. So we will never be significantly behind our peers, and we will never be in the last quarter. And I think that's a promise, and that's all the nice attributes from the passives are in this fund. So if somebody considers as a passive fund, should always consider our fund. Having said that, we are not here to compete with the pure passives. Our view is that our fund is an active fund. And why so? Because we include all the attractive elements of an active balanced fund into our proposition. We have within asset class alpha, I think our alpha profile is actually more promising than from most of the active balanced fund. Our alpha profile is steady. Our equity alpha is coming through every single year through our approach that we do not stock pick and that we port the fixed income alpha on top. We have an efficient allocation of capital, so we readjust on an ongoing basis for structural breaks, and we redo our strategic asset allocation frequently, definitely more than twice a year. We would adjust if there's an adjustment necessary. We review it at least on a monthly basis, and we capture market dislocations. So we are not pressed for TAA trades. We are convinced that even without any TAA alpha, this is a top quartile fund because we have within asset class alpha, because we have an optimized strategic asset allocation, and because we've got super low fees. But we do believe that we can create tactical asset allocation alpha by putting in place the right tilt at the right point in time. So that's how we capture market dislocation, and that's how the fund becomes full on active. So yeah, I mean, in a nutshell, it's really this marrying the benefits of passive and active investing and not substituting the one for the other. So if we just move on one slide, and this is basically our last slide, just a quick summary of how we see systematic investing and why this is our theme, and why as a company, as Prescient, we have subscribed to that. Well, we love the idea of being free from human biases. We do our tactical asset allocation tilts based on models which we design in-house, based on strong and reliable economic facts, but also by the support of data science. We create stable and predictable outcomes relative to our peers. That's through us not stock picking. So often here's the story: stock picking is not about picking the winners, but about avoiding the losers. Well, we have avoided all the losers because we don't stock pick, as simple as that. So if somebody has a saying already, it's perfect indication that stock picking doesn't work. So rather create fixed income alpha, which is more reliable, more stable, more predictable, and we port that on top of our equity building block. And then again, slowly but steadily, that's how we want to beat our peers. Not by shooting out the lights, but by beating them every single year on a 12-month rolling. There's one or two exceptions. Less than 10% would drop out of that second quartile. But as Kirsty said in the intro, we've never dropped into the last quartile, so we never have a long way to catch up. And lastly, the scalability. So we don't have a big team of analysts. We don't need a big team of analysts to cover certain stocks in detail. It's a pointless exercise, and look at the returns. That's actually the perfect proof. So if I look at the way the multi-asset team is designed, we've got 7 people in the team. Everybody has a strong background in economics. Everybody has done a CFA or is working towards a CFA. But on top of that, everybody has a strong understanding of data science, of stats, and the ability to set up efficient processes. And because of that, I think we are actually, with a smaller team, able to process much, much more data. So we have a couple of million data points which go into our system on a daily basis and which derive our investment decision. It's literally a couple of million data points on a daily basis. And we do that with a team of 7. I don't think that a lot of our competitors process that much information on a that timely basis. Okay, but what does that scalability mean? Running with a slim and efficient and strong team, what does it mean? We can run at lower costs. What do we do with the costs? Or cost savings also, we give them back to our clients, and we create low cost solutions. Not because we don't like to create, not because we don't like to take fees. It's more because we are just so convinced that there is a straight correlation between low fees and returns. We have to have low fees. Okay, so this is basically the Prescient Balanced Fund in a nutshell. Obviously, we are keen to take any questions now. So if there's anything which wasn't clear or which we could drill in a little bit more in detail, please give us a shout.
Thanks, Bastian and Rupert. That was great. I've had 2 questions come through. The first one is, how quickly can the fund implement a structural change? I think this comes after Tito announcing that there might be a change in Regulation 28 for the inclusion of infrastructure, I suppose infrastructure and development. So how quickly could you implement that kind of change?
Yeah, that's a good question. And I mean, plays straight into our strengths, this question, because with our data-driven process, we literally just have to adjust for the change in regulation, press the button, and we get a new optimal portfolio. This is a perfect proof why you cannot have a pure passive balance fund, and why you have to optimize, and why you also have to have the systems to do it on a daily basis. So the answer for me is, how long does it take to adjust for a change in regulation? 1 day.
And I think just to add to that, when we do our trading processes, we have essentially our target portfolios, and we rebalance every day. So because our trading fees are so low, given the instruments that we trade, we have the ability to rebalance every single day. So there's very little tracking error versus the underlying portfolio benchmarks or targets.
Thank you very much. And the second question, with government forecasts being very low for the next 3 to 5 years, is a multi-asset high equity fund still an appropriate investment choice?
So with government predicting, I assume, low economic growth?
Yes.
Okay. Yeah, so yes, of course. It's not just about economic growth, it's also about the real return environment. So I think it feels risky and it feels difficult after this steep recovery and after this, us still looking outside and seeing people running around in masks. So it is a challenging time, and so we've seen reasonably strong equity returns. Having said that, there are still a lot of opportunities out there. We do not think that South African equities are overpriced, and we do think that one must be cognizant also of the cut in interest rates. So we had a very convenient option over the last couple of years to use like a money market linked fund or something very, very conservative and get still to a CPI +3 return. This option has just disappeared. So with the SARB cutting interest rates so aggressively, and with interest rates most likely staying lower for longer, the alternative to these asset classes, which have still a significant risk premium where you can still extract higher returns, the alternatives have just basically disappeared. So we are convinced that on a relative basis, the option of a high equity balance fund is actually exactly the way to go in the current environment.
Great, thank you. I think that was a fantastic answer. I think that's us for today. I want to thank everybody for their time, and I'd like to encourage you to please reach out to your Prescient Retail Business Development Manager for any further questions or discussions. Thank you so much. Goodbye.
Thank you.
Thank you.
Cheers.
Cheers.